Live from the City of London this afternoon. Good afternoon. Equity futures just about positive on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, another day, another tech firm preparing to cut jobs. As the Fed goes quiet, the doves get the last word. And Morgan Stanley says stocks aren't pricing weak data. We begin with the big issue, soft versus hard.
We have seen very mixed signals.
All of the weakness that we've seen within economic data has really been within soft data.
Yes, there's been some weakness in the soft data in the U.S.
Survey data, sentiment data.
But overall, the hard data is looking good.
It really is a question of if we start to see hard data start to roll over.
In the U.S. in particular.
And I think that's the big question for the Fed.
It's going to be the PCE numbers, the core PCE.
We know inflation dynamics have morphed.
I think PCE is going to be key.
That's one of the key data points for the Fed and I think for the market.
I'm also watching those PMIs.
Every piece of data comes in, it's gonna tell us part of the story.
Joining us now to discuss that story is PGIM's Robert Tipp and Krishna Mamani of Lafayette College. Krishna, first to you, how much weight should I put on the soft data versus the hard right now? And the hard is saying things are okay-ish, and the soft data, the survey data, is saying things are bad.
Well, I think what matters right now is really the hard data far more than the soft data. We have been looking at the deterioration in soft data for quite some time. But in reality, either in the labor market or in growth numbers, the softness really hasn't materialized. So I think there's a sentiment this time around, maybe a little different because of all the things that the Fed is doing in the pandemic. The hard data is still very, very positive at this point in the tightening cycle.
Robert Tipp, which side of that are you on?
I think the narrative changed with the retail sales numbers. I mean, granted, surveys have been soft, but we've had an evolution. The hard data, the first series hard data was the negative retail sales, and it wasn't all the drop in gas prices. 2 months, big drop in retail sales. That on the heels of the ISM services new orders. Granted, that's soft data. I think that signaled a change in consumption behavior. Now that on the hard data side for consumption is soft, but it's absolutely true that on the income side, the job market has remained very firm. So I think what could be happening here is really a change in the savings rate. We saw a big boost in savings with all of the stimulus, and then savings have been drawn down. Savings rates have come down. I don't think things are necessarily bad. I just think that consumers may be choking up a bit, like me, choking up a bit on the consumption and boosting that savings rate back up.
Mike Wilson of Morgan Stanley weighed in on some of this. This is what he had to say on it all. He said, while consensus shifts to a less negative stance amid a weaker dollar, China's reopening and the more stable but lagging hard data, we focus on the leading macro and earnings indicators, which are now overwhelmingly weak, a dynamic the market is not priced for. That's Mike Wilson of Morgan Stanley. Krishna, I'd love your view on that, considering you think maybe the opposite on soft versus hard. Where are you on the market and what we're priced for?
So we are certainly not pricing in an imminent recession, which is what Mike is talking about. But the reason we are not pricing it is because it's not unfolding just yet. So it would be very hard for the markets to start thinking about a real hard landing. And in the context of where the labor market is and the fact that inflation is turning over. So, yeah, we will start pricing it when the actual data materializes. With respect to Robert's point, with respect to retail sales, I think retail sales may be a seasonal fluke from my perspective. If you look at the consumption data in other parts, in services and things like that, there's really not that much of softening at all.
Krishna, do you think then the pain trade is still up in the equity market? Is the pain trade equities higher?
Oh, 100%. I think the markets are still not priced in for a significant likelihood of a soft landing. I think the market levels, if we think that earnings are not going to be deteriorating rapidly, which would be the outcome in a soft landing, I think the pain trade is definitely 4,500 in S&P.
Krishna, where are you on the bond market then with that in mind?
Well, so the bond market is very challenging at the moment, primarily because it has rallied as much. So I think one can argue about valuations in equities a little bit, but in bonds, unless we have a hard landing, it's very difficult for me to see how the back end of the bond market rallies significantly from here.
353 right now, yields up 5 basis points on a 10-year, on a 30-year, higher by 5 basis points also to 370. Do you agree with that assessment, Rob, when it comes to the bond market? Hard to make the case for them to rally here without a hard landing?
I think that's true in the short term. And I think that over the next 6 to 9 months, while the Fed is wrapping up the tightening cycle, the back end, as a tactical move, could be under some upward pressure here. I think that, it is a very difficult market to evaluate the underlying economy, the valuations. And on that equity front and the risk appetite front, Morgan Stanley that you brought up had a very interesting piece of research highlighting the huge gap between changes in earnings expectations, where earnings are coming in, what typically happens, and the bearish implications. I think the one thing that may be missing from that analysis, which applies very well, that relationship that they're looking at, it hasn't applied as well in the pre-1980 environment. And it just so happens in those periods, the stock market, came off in advance of the bad economic news like it has this time. And also, interestingly, that was a very high rising inflation kind of environment. So I think, things are very confusing. People are, reticent to take a position, but big picture, it looks like for bonds, we're in some kind of a strategic buy zone, and equities are probably not as dangerous as some may be highlighted.
Equities right now pretty boring. This morning, at least, up 0.1% on the S&P, on the Nasdaq, up 0.1% also. Some breaking news moments ago. Let's get to that breaking news. We can do that with Abby. Hey, Abby.
Hey, John. Well, yes, we do have breaking news just moments ago. Microsoft is to boost its investment in ChatGPT maker OpenAI. This isn't entirely a surprise. Some folks last week were talking about the idea that this could happen. This will be the third investment in about 3 years. They also made investments in 2019 and 2021. Right now, they are considering an investment of $10 billion. This, of course, as ChatGPT is a bit of a talk of the town, if you will. It's very impressive in terms of this AI technology. It can write poetry, create content, even help folks solve problems. So again, Microsoft boosting its investment in ChatGPT maker OpenAI. What's so interesting about this, John, of course, it comes on the heels of Microsoft announcing layoffs, but they are boosting their investments here in their AI technology. And interestingly, also, OpenAI, a nonprofit, so Microsoft looking for a way to monetize this ChatGPT.
Abby, thank you. The stock up by about 0.6% in early trading. The opening bell about 23 minutes away. We'll talk about tech in about 5 or 10 minutes' time. The US getting another dose of economic data, the final dose of data ahead of February's Fed rate decision. Mike McKee on top of that. Hey, Mike.
Good morning, John. You were talking about soft data and hard data. How about some hard data wrapped in soft data to start the week? It's something we don't talk about a whole lot, but the index of leading economic indicators, kind of interesting to look at, because if you go back in history, you can see that it has turned down before every recession, and look what it's doing right now. We get that number a little bit later this morning. The rest of the week, it's really not till Thursday till we get anything interesting, and that's GDP for the fourth quarter. The first read on that, we'll see how business investment and consumer spending are going. And then on Friday, income and spending for the month of December. We got that disappointing retail sales report for December, but that's basically goods. What happened with services? Did people spend more money? And of course, the Fed's favorite, the PCE inflation indicator. And this is what we're going to want to be watching because Jay Powell and his colleagues have pointed to PCE services minus housing. And if you look at the rent index in the PCE core, it is much higher, has been growing at a much faster pace than PCE core. That's got to come down some before the Fed's going to be satisfied, but they also know that that's a lagging indicator and it's going to take a while. So we'll see how that turns out. And then, of course, next week we get the Fed meeting and Jay Powell can explain it all to us.
A welcome quiet period ahead of that Fed decision a week or so away. Mike McKee, thank you. Robert Tipp and Christian Mamani back with us. Robert Tipp, I want to come to you on this. This phrase that we heard from the Fed and also from the ECB as well, sufficiently restrictive. Are we sufficiently restrictive at the Federal Reserve, and how on earth would you begin to gauge that?
I think we pretty clearly are. I mean, the inflation data has rolled over pretty convincingly at almost all levels, showing that they have that on the right track. And the interest rate sensitive sectors of the economy, namely real estate, I mean, they're really feeling the pain. And so I think unless they 100% are asked to get a recession, they've done enough. And frankly, I'm surprised that they're going to be hiking at the next meeting or two. I think that they should be skipping meetings at this point to fully evaluate the impact of what they've done. Granted, I think going, overshooting 25, 50 basis points, I don't think will knock us into a recession. But I think you're right at that point. I think they are sufficiently restrictive.
Krishna, do you agree?
Well, I think we are getting there. But the real test, and the fact of the matter is that even the Fed doesn't know. I mean, they've been telling us that. That is, the way they would know that the policy has tightened enough is some downtrend in the labor markets. And so far, we haven't seen any. And I think that's really the core issue for the Fed. And they are not going to conclude that we are fully restrictive until the lagging labor market starts softening, which is kind of unfortunate because it may be too late in terms of over-tightening.
Robert Tipp, we've got to talk about that. Jobless claims 190,000, unemployment at 3.5%. The quits rate, pick out the quits rate just to look at, is higher. It's not lower. People are confident. They're confident about quitting their jobs and picking up another one. Robert Tipp, which one is it? Are we seeing cracks here, or is this labour market still very resilient?
We'll have to see how these layoff announcements come through. But everything points towards a really solid labor market. I mean, the jobless claims, which are high quality, very frequently released every week. The insured jobless rate is at 1.1%. That is an incredibly low level looking across history. That 190,000 claims, incredibly low number of people making new claims for unemployment insurance. So incredibly strong there. I think the one thing, though, is that is the Fed's job to seek maximum employment. And so while if they are clearly seeing signs of a wage price spiral, they aren't. What they're seeing now is people are asking for wages to get made whole for the kind of inflation that they saw, and they have not been made whole. So you have to expect people are going to ask for that. Last week, we saw record low union membership, right? So labor is not picking up massive power here in terms of wages. Their job is full employment. That inflation has really rolled over. I mean, the ex-food, energy, shelter has been negative for 3 months in a row. So I think I think they're right there, and I think they're going to get that soft landing.
We'll keep talking about it, particularly the labour market. We'll have that conversation in a moment. Robert Tipp, Krishna Mamani sticking with us. In the labour market, in the tech sector at least, things have been brutal. I was going through the numbers earlier this morning. Microsoft, 5% of the workforce set to go. Alphabet, 6% of the workforce. Salesforce, 10% of the workforce. Meta, 13% of the workforce. Coming up, big tech continuing to make cuts.
Right now, it's an excuse for these companies to cut after spending like 1980s rock stars.
It's Spotify up next.
We still see another 5 to 10%. If we get into the middle of the year and there's more and more cuts, that's where it gets darker. But right now, it's an excuse for these companies to cut after spending like 1980s rock stars.
Only Dan Ives of Wedbush could say something like that. Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees. The CEO had this to say: an effort to drive more efficiency, control costs and speed up decision making. The move follows Meta slashing 13% of the workforce, 10% at Salesforce, 6% at Alphabet, 5% at Microsoft, totaling more than 44,000 jobs cuts among the 5 companies. And Katie Lyons, you wonder how much work Amazon's got to do, even with its recent announcement.
Yeah, that's a really good point, because remember, just over the last 3 years or so, since 2019, Amazon has added more than 740,000 people to its workforce. This is really what it's all about for these companies, John. They added headcount dramatically. For Spotify, they have more than double the amount of employees today they did in 2019. Their total workforce right now about 2,800 people. So with that 6% cut, that equates to roughly 600 jobs. And then you look at the other companies you mentioned that have cut 12, 11, 10,000 people. In the case of Alphabet, Meta, and Microsoft, they all also added tens of thousands of people people to their workforce really over the course of the pandemic when it was boom time for these companies. We are no longer in a boom time kind of macro environment. And to put it into perspective, how much things are softening in the tech sector in particular, just take a look at profit projections for the fourth quarter that they're getting ready to report. The information technology sector is expected to see profits drop by 9%. That would be the most going all the way back to 2016. But of course, it's not just tech as an industry that is suffering. This really has the potential to widen out beyond that sector. A new NABE survey of business economists just released today said nearly 20% of respondents expect employment at their company to fall in the coming months. That's actually the first time since 2020 that more expect falling rather than increased employment in the next 3 months. And about a third of companies say they are not facing any labor shortages. So this is definitely something we will have to continue to keep our eyes on as Spotify, just the latest in a string of these announcements, John.
Katie Lines, it goes on, it goes on, it goes on. Another day, another set of job cuts. The one statistic that jumps out to me, and I think we gloss over it way too much. 2019, Amazon, 800,000 employees. 2 years later, 1.6 million. 800,000 to 1.6 million in something like 2 or 3 years. That is absolutely ridiculous how quickly that has happened. Robert Tip, Krishna Mamani back with us. Krishna, this is where the excess has been. This is where you'd expect there to be cuts. I think we're trying to work out whether the cuts we've seen so far are sufficient or whether we're going to see a whole lot more.
Well, so, we can talk about the tech sector, but in the overall GDP economic context, it doesn't really matter that much. It matters for the sector, but for the overall economy, that's not where the problem is. The problem is in the bottom the bottom quintile of the labor force. That's where we are missing the workers. That's where 2.5 million people have just disappeared. And that's the sector, or that's the part of the economy that the Fed is focused on. And if you look at continuing claims, which I think indicates that more than anything else, there is really no softening in that part of the market. And that's a problem for the Fed. I'm very hopeful they will solve it, but it doesn't look like it's working right now.
Robert Tip, you think there will be a soft landing. Can I ask two things of you? Can I ask first of all how you define that soft landing, and then I'll follow up with something else. What do you mean by soft landing? What does that entail?
Sure. I'm glad you asked that. And I'm going to crack a little bit on that soft landing. I mean, we've seen booming growth, and the majority of forecasters in the meantime looking for a recession. And I've been skeptical about that because the things that usually drive a recession or exacerbate a slowdown, like a huge bubble in asset markets, overinvestment in certain sectors of the economy, very aggressive lending, all of those things that once you have a slowdown drag you into a recession, they're not really there. So I think to say a soft landing would mean that you go down towards 0 to 1% growth for a quarter or two, then you reaccelerate. There's no recession. And I think that the economy right now feels better than it is. The growth rates are low, but people feel jobs, and the job market is strong. So that would be a soft landing. I think with those retail sales numbers and that ISM services dropping, well below 50, that opens up another linguistical possibility for people like Mamani and myself, Krishna and myself, who've done this for decades, would be the touch and go. That maybe you're going to have like a quarter of negative GDP growth, but then the thing reaccelerates. And I mean at a real operational level. We saw some technical negatives in 2022. But that's how I would define a soft landing. Into that 0 to 1 briefly, and then reaccelerating.
Well, the follow-up question then, Robert, is where is inflation in that world, where growth drops down to 0 to 1 and you've seen the labour market still resilient? Where's inflation?
Yeah, well, I think the thing that people forget is that inflation requires real proximate causes. And in the 70s, people want to blame it on Arthur Burns and the Fed, but there were oil price shocks, and that went all the way through the economy. And then we had a surfeit of oil in the 80s, and the inflation went away. The economies run themselves a lot more than the central bankers run the economy. And so we've had a war, we had COVID, we had supply chain disruptions. Those things are passing. The supply is coming back, and we're seeing the inflation. The leading indicators for inflation have been pointing south for some time, and now we're seeing it come through in the data. So I think, are we going to be we're going to be somewhere on the PCE around that 2%, looking 6 to 18 months out in the future, as it is dragged down by commodity prices, but also your underlying areas as well, all the way through the housing market.
Can I just pick up on that line? And Krishna, can I ask you if you agree, whether all of those things can take place if the Fed just gets out of the way?
Well, that's a hypothetical that's not going to happen, which is the Fed is not getting out of the way, fortunately or unfortunately. They're doing what they need to do. That's their job. The key issue is, I think from the Fed's perspective, everything is slowing down, everything is falling in place. The real question for them is how patient do they want to be when they get too close to 5%? Do they want to stay there for a very long period of time for PCE to come down to 2%? If that's the case, we will probably have a hard landing, because that'll take a long time and the economy cannot sustain it. I think at some point they may kind of brush it, the 3% number, they may brush it under the rug a little bit and accept it and move on, because they don't want to total the economy either.
That's what people worry about, or some people are excited at the prospect of it happening, depending on how you think about these things. Krishna Mamani, Robert Tipp, to the two of you, thank you, as always. Equity futures right now on the S&P up around about 0.1% on the S&P 500, 6 or 7 minutes away from the opening bell. Coming up the morning calls, and later, Mandy Zhu of Credit Suisse will be joining us, expecting a year of elevated volatility. That conversation just ahead, the opening bell just around the corner. Equity futures just about positive here on the S&P 500, up about 0.2%. On the Nasdaq, up 0.2% also. In the bond market, we look a little something like this on 2s, 10s and 30s. Your 2-year yield on a 2-year Treasury higher by 4 basis points. The 10-year up by about 5 basis points. Let's get you some morning calls. First up, JP Morgan upgrading Wayfair to overweight from underweight, citing a positive shift in market share trends and its newfound commitment to controlling expenses. That stock up big time in the pre-market. Your second call, Barclays upgrading AMD to overweight, $85 price target, recommending semiconductor companies offering exposure to data centers, PCs and handset markets. That stock's up by about 2.5%. And your third and final call comes from Deutsche Bank, downgrading Workday to hold, expecting another volatile year for software stocks amid weakening fundamentals. That stock is negative here by about 1.1%. Coming up, Microsoft earnings on deck as Spotify announces the latest round of big tech layoffs. That conversation up next with Mandy Zhu of Credit Suisse, with equity futures on the S&P 500 just about positive by 0.2%. Your opening bell is up next. Coming off the back of the first weekly loss of 2023, equity futures trying to bounce back, up by 0.2% on the S&P after ending Friday with a decent day of gains, that's for sure. On the Nasdaq, up 0.2% on the Russell, up a little more than 0.1%. The opening bell in New York City rings. Switch on the board and get to the bond market. Yields look a little something like this on a 10-year. Your 10-year yield in the Treasury market up 5 basis points, 3.53. Euro dollar had a little look at 109 earlier on in the session off the back of more ECB hawkish talk. Euro dollar comes back down to earth, 108.53, just about negative on the session now. And crude 82 and about 10 cents. We're positive there by about 0.5%. The opening bell then about 20 seconds in. This Monday, equities advancing by a little more than 0.1% on the S&P 500. On the Nasdaq, up by 0.2%. One stock to watch at the open, Salesforce. Activist investor Elliott Management taking a multi-billion-dollar stake. The hedge fund writing in a statement the following: "We look forward to working constructively with Salesforce to realize the value benefiting a company, befitting a company of its stature." Ed Ludlow has more on the West Coast. Hey, Ed.
Yeah, good morning, Jonathan. They're up around 3% on Salesforce at the open. Not the same kind of fizzle and exuberance that we saw in pre-market trading. But as you said, a Bloomberg source talks about this being a multi-billion-dollar stake. In the statement you just read out, Elliott did not confirm the investment details or give us a number. But the idea here is that Salesforce grew phenomenally throughout the pandemic period, right? We're at a point where when it reached its November 2021 high, it had a market cap of $300 billion. A lot of that growth was organic, but also inorganic. M&A has been a big feature of Mark Benioff's focus over the last few years. And like many tech companies that you see now unwinding, Salesforce became quite bloated. The reaction from the sell side is this is not a surprise, right? Starboard was the first activist to come in October for Salesforce. They're not surprised that Elliott's coming in now. There's a consensus that the outcome could be good, right? That if you take at face value what Elliott is saying it wants to achieve, actually a focus on profits and shareholder returns could align with what Mark Benioff wants as well, and kind of unwinding some of that pandemic era exuberance. This terminal chart's really interesting. It's not just that drop in market cap November 2021 to present day where it's basically half, but if you look at forward 12-month price to earnings, this is a cheap stock, right? Historically, at least, forward 12-month PE near its record lows that were set during the global financial crisis. So what I'm seeing in the notes I've read this morning is opportunity, and the stock obviously reacting positively, John.
Ed, thank you. The stock up this morning by 2 or 3%. More broadly, about 2 minutes into this, equity's now dead flat on the S&P 500. On the Nasdaq, we're positive by not even 0.1%. Another stock to watch, Baker Hughes, reporting results and turning to cost-cutting measures. This is what they had to say in a statement. We remain focused on optimizing our corporate structure and drive improvements in our margins and returns profile. Abby has more. Hey, Abby.
Hey, John. Well, yes, and investors at this point seem to like the strategy. The shares are up more than 1%. Now, on the surface, a little bit of a messy quarter. They missed both sales and profit estimates. But what they did do is they beat new orders. They're expanding there to, $8 billion. That represents 20% year-over-year growth. So some real strength there. As for revenues, there was also growth there, 7% year-over-year, but they missed by about 3%. Earnings of 38 cents, 2 cents shy, but that's more than 50% year-over-year growth. So net, the numbers are going in the right direction here. Margins are moving in the right direction, too. Net income of 3.3% last year to high single digits in the years ahead, John. So again, the company's cost-cutting profile idea that is seeming to help the company move in the right direction. And they're targeting $150 million of cost cuts by the end of 2023, or 60 to 80% of free cash flow return to shareholders. Overall, John, we've had a couple earnings coming in place, of course, for the financials, some of the techs, but Baker Hughes kicking off what could be a very strong fourth quarter for energy, 58% year-over-year EPS growth, not so shabby at all, John.
The stock up just a little bit by 5 or 0.6%. I think we hear from Chevron later on in the week. We need to talk about Spotify as well, joining the growing list of tech firms cutting its workforce. The CEO had this to say, and it's going to sound a whole lot like something you've heard before over the last month or so. I was too ambitious in investing ahead of our revenue growth, and for this reason, we're reducing our employee base by about 6% across the company. I take full accountability for the moves that got us here today. Katie Lyons, we've heard that from pretty much every CEO, I think, over the last few months in this sector.
Yeah, we have. The deja vu is getting severe, John, because it is the same. I take full responsibility. We hired too much too quickly, and now times have changed. To put it in perspective, for Spotify, back in 2019, they had about 4,400 employees. As of the end of last year, they had 9,800. So their workforce has more than doubled. The 6% cut announced today will equate to about 600 jobs that are going to unwind here. And the company's going to take a charge of between 35 and 45 million euros in severance-related charges. We'll see where these layoffs, though, are targeted within the company, John, because remember, Spotify had already laid off dozens of people from its podcast studios in October. And this comes back to the investment that the CEO was talking about. The company made a big commitment to that podcast business beginning in 2019, spending over $1 billion on acquiring podcast networks and the rights to popular shows. And that spending for content has weighed on the bottom line. Spotify has really struggled with profitability. And in this market, profitability is increasingly important. Our analysts here at Bloomberg Intelligence, though, say that these headcount reductions announced today will boost margins as Spotify deals with slower subscriber growth. But can it provide a substantial boost to the stock, John? It is this morning. The stock is up about 6% in the first few minutes of trading here. But remember, it fell 66% in 2022. So far, 2023 shaping up to be a better story. It was up 24% year to date as of Friday's close, and obviously adding to the gains this morning. It is another pattern, in addition to CEOs taking responsibility, that the market reacts really kindly to these kind of job cuts announcements, John.
I've seen this movie about 10 times year to date, 3 weeks into the year. Katie, thank you. Tough time for that sector. Mandy Zhu, Credit Suisse, expecting a tough year ahead for stocks. She writes the following. The outlook for equities remains fraught, with economic growth set to decelerate sharply. With diminishing market liquidity, realised volatility is likely to stay elevated. Mandy, I'm pleased to say, joined us right now. Mandy, great to catch up with you. I was going through your notes, and this number jumped out. You've got the VIX averaging 25 for the year ahead. Can you walk me through that?
Yeah, sure. So, I mean, obviously markets started off very strongly for the year, but one of the reasons we do expect the VIX to remain relatively elevated, at least for the rest of the year, not only because of the macroeconomic backdrop, which I think everyone is familiar with, but also on the back of diminishing market liquidity. And I think that's a point worth emphasizing, is that liquidity in the underlying equity market, particularly equity futures, is actually worse now than in 2020, right? So if you look at top of book depth for the E-minis, which is supposed to be the most liquid instrument for the equity market, it was on average about 26% lower last year compared to 2020, when VIX was obviously much higher. And that was one of the reasons when we talk about equity vol, not doing much last year, everyone focuses on the VIX, right? Implied volatility didn't do much last year, but realized volatility actually doubled last year compared to the year before. So we expect low liquidity as well as challenging macro fundamentals to provide a boost, continued boost to realized volatility, and that is likely to put a floor for implied volatility for the year.
So Mandy, there's 3 points there. Low liquidity, real macro vulnerability on top of higher volatility. Put that all together, do we have to adjust our return assumptions a whole lot lower this year?
So, it's interesting because obviously the market started off strongly this year, and it started off strongly on the back of falling inflation and inflation expectations, which is good. But, I do think it's going to take time for markets to figure out whether inflation expectations and inflation is falling because we're going to a soft landing or we're going into a recession. And for equity markets, those two mean very different things. So I think there's a misconception, at least, that, that pivot is generally good for equities. When we take a look at the data historically, it's actually, it really comes down to whether or not we go into a recession. So in periods when the Fed starts cutting rates and we ultimately go into a recession, equities have actually returned double-digit negative returns in the months following, right? So I think for bonds, falling inflation unambiguously good. For equities, it's gonna take time to see. And not
so
just for
you're suggesting, Mandy, just to jump in, that equity bond correlation that normalizes.
Yes, so that was so higher inflation and persistent inflation was the reason why equity bond correlation broke down last year. And we expect at least this year it to start to normalize again, because again, we're going from peak inflation to now focus about growth in environments where markets more focused on downside risks to economic growth. That equity bond correlation goes back to negative.
Mandy, with that in mind, can you tell me how investors have been using the first few weeks of this year? Pretty strong price action. Did you notice they were chasing returns or were they reloading shorts?
Yeah, sure. So I would say on the equity vol fund, the most consensus view is that this year we're going to very much remain in the same regime as last year, meaning, equity vol underperforming, skew underperforming. So most of the structures that we've seen in equity vol space is actually more looking at selling volatility and selling skew in particular. We really haven't seen convincingly, large upside call buying in the market to chase that upside return. For me, really for markets to potentially start to realize on the downside, we really need investors to re-risk and add leverage. And with realized volatility as elevated as it currently is, I think it's going to take a while.
I wanted to get to one trade of yours and talk about cyclicals with you. A lot of people are trying to price this cyclical recovery off the back of China reopening, doing that through China or doing that through Europe. JP Morgan and Mislav Matejka talk about Europe specifically when they say this. They said the recent cyclical rally is discounting the rebound of PMIs into expansion territory, but this might not be confirmed by a sustained activity improvement. This leaves earnings projections susceptible to further downgrades with cyclicals in particular at risk. You've got a trade, Mandy, that is perhaps related to this somewhat. The Euro Stoxx 50 versus Euro dollar. Can you walk me through what you're expecting?
Yeah, sure. We actually have a couple of trades all along this theme that, the rotation of growth into value last year, this year, I think this year is going to look increasingly vulnerable. And I think a lot of the sectors that are so-called value sectors are also cyclical sectors. and they're going to be vulnerable on the downside, obviously, if we go into recession. And European equities, broadly speaking, fits in that category. Obviously, from a valuation perspective, it did better last year given the focus on higher rates and higher inflation. I think this year, where kind of the genesis of the idea came from is our view that peak inflation is really a U.S. story. We actually expect core inflation to continue to rise in Europe on the back of sticky wages. So here, really, this is a play for more hawkish ECB policy. I know there have been some headlines recently suggesting a more dovish turn by the ECB. We don't think that's going to happen. So more hawkish ECB focused on taming core inflation in Europe, putting pressure on Euro stocks. And while providing support for the euro. And in terms of entry levels, I would say, obviously, entry levels to add protection for euro stocks is good. But from the trade perspective, it also takes advantage of the historically elevated correlation between European equities and Euro USD. So, that provides a really good discount with the structure.
Mandy, super smart, super smart, and it has been too long, so let's catch up again soon. Mandy Zhu there of Credit Suisse with euro dollar breaking through 109 a little bit early this morning and then rolling over. Equity futures were positive going into the opening bow, positive coming out the cash open. We're about 12 minutes into the session. We're positive now by 0.2% or so on the Nasdaq, up by about 0.5%. Coming up, investors weighing the odds of a US recession.
If you look at market indicators, recessions don't seem to be on the cards, but the way that we see 2023 playing out is that a recession is foretold.
Up next on this program, Mike Gapin of Bank of America pushing back his recession call. That's next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Apollo Management Chief Economist Torsten Slok. That conversation at 2 p.m. in New York, 7 p.m. in London. This is Bloomberg.
The way to reconcile the two narrative is that markets are certainly pricing out a recession, right? If you look at market indicators, recessions don't seem to be on the cards. But the way that we see 2023 playing out is that a recession is foretold because we're not out of the woods with inflation. Central banks, including the Fed, will have to power through and push on in terms of rate hikes.
The recession debate heating up, BlackRock laying out two conflicting narratives. Bank of America's Mike Gapin weighing in with his own outlook, writing the following. We see enough momentum in consumer spending to push the start of a mild recession into 2Q from 1Q previously. Mike, I'm pleased to say, joins us right now. So to the second quarter from the first quarter, Mike, great to catch up with you. Let's talk about that subtle shift. What's behind it?
Well, as you said, as you noted, we said that there's just enough momentum in consumer spending. So certainly last week, we had evidence, firm evidence, that the slowdown is broadening outside of housing. It's now squarely in the manufacturing sector. But a willingness to use excess saving, a very strong labor market, and maybe some easing in financial conditions has kept the consumer spending. And so we think this week we'll find out personal consumption grew at a 2.5% annualized rate in the fourth quarter, so still very strong. So all of these factors are a tailwind at the moment for spending. So we think that means the expansion goes on a little bit longer. We only moved it back a quarter, so this is not a major change, but we do have to respond to what we're seeing. And right now, there's enough momentum that suggests maybe Q1's too early and something closer to the middle of the year seems more likely.
Mike, you pushed this back. Did you change your Fed call alongside it?
Well, we did in the following sense. It seems clear they want to slow down the pace of hikes again. So that, that seems like the obvious change. So we're now looking for a 25 basis point hike in February instead of 50 that we had before. We've kept the terminal the same. The message seems to be we want to slow down, but we are still considering a terminal rate around 5% or above. So we stayed at 5 to 5.25. I think risks around that are balanced. If the economy deteriorates more quickly and inflation continues to slow, maybe they hike and pause in March. But the labor market has been strong, and it's been hard to slow that down. So you could argue that the Fed may have to even do more than the 5 to 5.25 we're thinking. So it's pretty fluid right now. So we just have them slowing down, but still getting to the terminal just above 5%.
Well, Mike, let's talk about that labour market. 3.5% unemployment. Jobless claims in the last week coming in at 190,000. I mentioned it a little bit earlier this morning. We look at the quits rate. The quits rate still elevated. Job openings still suggesting something close to 2 openings for every unemployed American. Mike, when we get to the second quarter, what do you think those data points look like?
Well, I mean, we have the unemployment rate rising a little bit above 5% at its peak. And so you're likely going to have some job losses to get that. So we do have employment growth slowing, kind of continuing the pace at which it's slowing, and then turning negative for a while starting in the second quarter. So think maybe 3 to 6 months of softness in hiring and maybe some negative payroll growth. So we have that happening now in the second quarter. The labor market's slowing in that direction, but as you note, on balance, things are still pretty tight, and therefore it suggests the Fed has some more work to do, and it's just going to take longer to kind of remove those imbalances in the labor market.
Mike, do you think there's a growing risk that it gets pushed further out, perhaps towards the end of the year, and maybe not at all this year, given how strong some of those data points are?
That's right. We've always said the main risk to our outlook is that the economy just keeps going, and that it's always pretty difficult to slow down the U.S. economy. And if the Fed's really conscious about trying to soft land this and not overdo it, then I think the risk is in the direction of there's enough saving on balance sheets and there's enough employment growth that just keeps the recovery going. So yes, I think the risk is that we have to push things out as the year progresses. That's true.
So the risk for them, they're trying to balance these two risks of doing too much versus doing too little. A few months ago, overwhelmingly, we were told by Fed officials, including Chairman Powell, they believed that the risk of doing too little outweighed the risk of doing too much. Clearly, they now believe those two risks have come into balance. Mike, the way you look at things, do you think the greater risk now as they slow down towards 25 is that they have to pick things up again in the second half of the year?
I don't think so. I think from here, they would just the funds rate would leak higher, 25 basis points at a time. I would be really surprised, for example, if they kept hiking and say the funds rate for some reason was approaching 6%. Would the economy power through that? Probably not. I'd be really surprised if we weren't slowing down with a real policy rate that high. So I think from here they can go in 25 basis point increments and still have plenty of time to kind of let this play out. And if they have to go more, I think they can do that. I think the risk of acceleration would be low. So I would say they just maybe keep going at 25 if that's what the data suggests.
Mike, just a final question from me. Sitting here in London, opening up the Financial Times this morning, the headline on the front page, as you might expect, the Eurozone set to escape recession. We look to China and we talk about the reopening over in China as well. Have you got any thoughts on the kind of growth impulse the United States could import from a better Europe, relatively speaking, and a China that could see 5-6% GDP growth depending on how this reopening goes?
Yeah, I mean, the trade channel in the U.S. is pretty small, so I wouldn't overplay that. I mean, and we've been kind of arguing actually the weaker the rest of the world is, the more that helps the U.S. because gas prices come back down. So I think it's about neutral. If Europe is doing better and China surges in the second half of the year, maybe commodity prices move higher and we don't get relief on gasoline prices anymore. But we would get a modest boost from trade. So I think that actually kind of washes out when it comes to the U.S. We're just not as driven by global growth as other economies.
And Mike, this was great. Hopefully we can catch up again next week around the Fed decision. Mike Gapin there of Bank of America pushing out his call for a recession in the United States from the first quarter out to the second quarter, with a real risk that gets pushed even further out through the rest of this year. And for the likes of Neil Duffer of Renmac, maybe not this year at all, given how things are materialising at the moment. Equities right now, decent day of gains on the cards, maybe up 0.5% on the S&P, on the Nasdaq up 1 full percentage point. Abby has more. Hey, Abby.
Hey, John. Yeah, we do have the S&P 500 up about 0.5% at session highs on basically a volume that's equal to what it's been over the last 20 days. Not surprisingly, with the gain, we have three of the big heavyweight tech sectors higher: tech, communication services, and discretionary. On bottom, we have real estate, utilities, materials, and healthcare flipping right around. So utilities on the bottom, one of the defensive sectors. One sector that's really outperforming, helping out technology, John, is the chip sector. The SOX is up 2.7%, helped out by Qualcomm and Advanced Micro. Barclays is very bullish on chips, raising price targets and reiterating overweight ratings, John. This sector up 36% since the October low.
Abby, thank you. Up next, your trading diary. About 26 minutes into the session, equities up 0.6%. Let's get you the trading diary. US PMIs coming up on Tuesday, plus big tech earnings kicking into full gear with Microsoft after the close, Tesla, IBM on Wednesday, US fourth quarter GDP and another round of claims coming up on Thursday. Finally, PCE numbers and the UMich sentiment survey rounds out the week on Friday. From London, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. I'll be with you tomorrow morning. This is Bloomberg.